Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in the world of business and finance. Today, we are diving deep into a financial report that might seem a little dry at first, but trust me, there are some serious insights tucked away in here. We are talking about the latest shareholder report for Northern Lights Fund Trust. Now, this document is essentially a detailed checkup on how certain investment funds have been doing over the past year. It gives us a look under the hood at their performance, their costs, and what they've been investing in. Think of it as the company's annual report card, and today we are grading it. First up, we have the Astor Dynamic Allocation Fund. This fund aims to grow your money and provide some income by mixing different types of investments. They have different share classes, meaning different ways to invest, and each has its own costs. Class of shares, for instance, had about $144 in costs for every 10,000 invested. That is a pretty standard fee for this type of fund. Now, the big question, how did it actually perform? For the year ending the 31st of July 2025, the class of shares returned 6.33%. Now that might sound okay, but compare that to their benchmark, the 60% S&P 500 index and 40% Bloomberg US Aggregate Bond Index, which returned a much stronger 11.15%. So while the market was generally up, this fund lagged behind, making investors a bit less happy than they could have been. The report mentioned something called the Astor Economic Index, which remained in a balanced position. This means the market wasn't showing super strong signals, but it wasn't crashing either. This stability contributed to the fund's slower performance compared to the benchmark. They also point out that the stock market was a bit uneven. Large tech stocks did really well, but smaller companies did not fare as well. Looking at the long-term performance for a hypothetical $10,000 investment shows an interesting story. If you had invested in the Astor Dynamic Allocation Fund July of 2015, your investment would have grown to about $16,000 by July of 2025. That sounds good, right? But if you had put that same $10,000 into the S&P 500 index, you'd have over $35,000. That is a huge difference, showing that this fund has really lagged the broader stock market over the last decade. Next, we have the Astor Sector Allocation Fund. This one aims for capital appreciation, meaning it wants to grow your money. For class of shares here, the costs were around $147 for every 10,000 invested. Similar to the Dynamic Fund. Performance-wise, the class of shares returned 9.76% for the year. This is better than the Dynamic Allocation Fund, but still significantly less than the S&P 500, S16.33% return for the same period. The report explanation talks about sector allocations moving in and out of different industries. It seems like they made some smart moves initially, but then some of those bets didn't pay off as the market shifted. Again, looking at the 10-year chart for the Astor Sector Allocation Fund, we see similar trends. A $10,000 investment in July of 2015 would have grown to about $17,924 by July of 2025. Again, a decent gain in absolute terms, but dwarfed by the S&P 500. More than $35,000 outcome. These funds have a total of about $65 million in net assets. That is not a tiny amount, but it is also not massive in the grand scheme of the investment world. They hold about 14 different investments. Interestingly, both funds are heavily invested in exchange-traded funds, or ETFs, making up about 98.7% of their investments. This means they are essentially buying baskets of other investments rather than picking individual stocks or bonds themselves. Looking at their top holdings, we see a lot of ETFs too, like the Spider Portfolio S&P 1500 Composite Street, OC Market ETF, and the Spider Portfolio S&P 500 ETF. They also hold things like the Janus Henderson AAA CLO ETF and various PIMCO ETFs focusing on commodities and bonds. This fund of funds strategy is a key part of how they operate. Now, for some significant news, effective the 1st of August 2025, Beacon Capital Management Inc. took over as the advisor for these funds. This is a big change, and investors should pay close attention to how this new management team steers the ship moving forward. They are also planning to reorganize the funds into a new series later next year, which will require shareholder approval. So what about the cost for Class C and Class I shares? Class C shares had a higher cost of $221 for every 10. invested. This is because Class C shares often have ongoing distribution fees. Class I shares, the ones for big investors, had lower costs of $119 for every 10. This fee difference for different share classes is pretty standard. The Class C shares returned 5.43% and Class I shares returned 6.54%. These are again lower than the benchmark and significantly lower than the S&P 500 over the long term based on the provided tables. This consistent underperformance compared to broad market indices is a recurring theme across these funds. Let's quickly touch on the auditors. The accounting firm Cohen and Company Limited, they audited the financial statements for both the Aster Dynamic Allocation Fund and the Aster Sector Allocation Fund. The audit fees for each fund were around $14,900 for both 2025 and 2024. They also provided tax services costing $3,000 for each fund in both years. It is good to see these fees are clearly itemized. Looking at the financial statements, we see the Aster Dynamic Allocation Fund had net assets of $65 million as of the 31st of July 2025. The schedule of investments shows they hold a lot of ETFs, like the IMGP DBI Managed Futures Strategy ETF, and various PIMCO ETFs, which aligns with their asset weighting. The Aster Sector Allocation Fund had net assets of about $16.2 million. Their top holdings also lean heavily on ETFs like the Technology Select Sector Spider Fund and the iShares Short Treasury Bond ETF. The statements of operations show the income and expenses for the Aster Dynamic Allocation Fund. Investment income was about $2.3 million. Expenses, including advisory fees, administrative fees, and other costs, amounted to about $1.2 million. This resulted in a net investment income of over $1.3 million. For the Aster Sector Allocation Fund, investment income was around $401,000 with expenses around $475,000. They actually spent more on expenses than they earned in investment income for the year. It is important to note here that advisory fees were waived and expenses were reimbursed by the advisor by around $223,000 for this fund. Without those waivers, the fund would have been operating at a loss. Now, my take on all of this, these funds seem to consistently underperform their benchmarks like the S&P 500 over the long term. While they did make money for investors in the past year, the returns were significantly lower than what you could have gotten from simply investing in a broad market index fund. The strategy of investing heavily in other ETFs might offer diversification, but it doesn't seem to be leading to superior returns. The change in advisory makes it a situation to watch closely. Will the new advisors bring in a fresh approach, or will the funds continue to trail the market? It remains to be seen. The auditors gave a clean opinion, meaning the financial statements are presented fairly. This is a good sign for transparency. The report also includes a detailed explanation of why the board approved the investment advisory agreement. They looked at the advisor's services, performance fees, and profitability. For Aster Dynamic, they noted it was profitable, and for Aster Sector, it was not profitable before marketing expenses. They agreed the fees were not unreasonable, and that the expense limitations were beneficial for shareholders. Interestingly, the report mentions foreign tax credits. For the fiscal year ended the 31st of July 2025, neither fund had any foreign taxes paid or foreign source income. This is a notable detail suggesting their investments are primarily domestic. So that is our deep dive into the Northern Lights Fund Trust's latest shareholder report. While the past performance of these specific funds has been somewhat disappointing compared to market benchmarks, the good news is that the financial reporting is transparent. The change in leadership is a key event to monitor for future performance. What do you think about these funds and their investment strategy? Let us know in the comments below. Don't forget to like this video, subscribe to Corporate Decoder for more business insights, and join our growing community on Discord. The link is in the description. Thanks for watching, and we'll see you in the next episode.